All right, we are live and we're going to dive into everything about the real estate market here in Denver and why rates might stay longer. We're jamming out. Let's have a good day, guys, and dive in. I'm going to share my screen as I always do. Guys, if you have any questions, you're joining me live, comment where you're from and what questions you have, and we'll make sure to. If you're catching this as a replay, still comment your questions, and we'll make sure to check those and get to them on next week's live. Every Wednesday, we're going to do one of these reports, guys, and looking forward to hearing from you. Let's go into it. Weekly market brief, November. In post-election relief of finally it's over, buyers got back to business. While half of the country may have been disappointed with election outcomes, interest rates are the highest they've been since end of July. Believe that. Can you believe that? Rates are the highest they've been since July. Super interesting. We'll get to that shortly. Pre-election lull of showings turned into a one-week spike of buyer activity. We'll see if that's sustained. We also experienced a modest increase in new listings hitting the market and properties going under contract. Let's not look at any of this activity as silver lining to a bad market. We are in a very solid market with great fundamentals, with an interesting factor we haven't seen in a while, which is buyer behavior that doesn't seem to be as sensitive to interest rates as they've been. Guys, I agree with this very much. It is a very solid market with great fundamentals. See, the thing about this market, I think, is really, it's a really healthy market. Even though we have increased levels of inventory, it's taking longer to sell homes, etc. Like, seasonally speaking, we're in a really good spot here. In the comment about buyers not being as sensitive to interest rates, I think people are just sick of it. They're just sick of high rates. They're sick of sitting on the fence waiting for something to happen. And so, you know, there's a handful of buyers that are just making things happen. And not having, you know, the ability to wait for years until rates improve to where they need to be. Picking back up where we left off. In the meantime, it's important to know that history is repeating and the seasonal market changes are doing exactly what we expected. Yes, that is very true. These are not bad signs. These are not things to be concerned about. Guys, it's so true. It's just a seasonal market. We're seeing the shifts that we generally see every time this year, and that's to be expected. Now, what's going to happen in 60 days? We will likely see all the below begin a radical shift into the spring market conditions. Yes, 100%, especially if rates drop. Again, we'll get into that shortly. But for the next 60 days, days on market are spiking. Seller concessions are rising. Offers under asking are increasing. Price reductions are increasing. Showings will slow going into Thanksgiving and through the rest of the year. Guys, it's holidays. Like, not a lot of people are buying homes. The market tends to slow down as we go into Thanksgiving and Christmas. It's just the natural way of human beings and the way we work. Inventory will continue to decline as more homes are pulled off the market for holidays. I'll show you an interesting little graph here in regards to inventory. And then the average sold price will slide before beginning to rise in early April. So let's just dive into home prices real quick. We'll go to where's my graph? Oh, sorry guys, on the wrong page. So if we're looking at pricing and why we're saying pricing will likely slide, well, it's because generally it does that every year, right? So we're right here in week 46 of 2024. As you can see, 2021, 22, 23, pricing this time of year tends to drop. It tends to retract. You don't see as much of that in 2021, but that's because interest rates were wildly low. But 2022, 23, and 24, you just see a downward trend in pricing. And that's because all of the things we talked about in this report, days on market are spiking. When houses are staying on the market longer, pricing tends to decrease. Seller concessions are rising. That's a factor of being a slower market. As you can see right here, the upward trend towards year end is happening, with the average contract ending last week with seller concessions of 7,409. With interest remaining elevated, expect concessions to end the year over 8,000 per contract. So this is a graph, guys, which is really cool because you can see where concessions are And you'll see, so slow market, and it kind of, as the market picks up, you get less concessions and it kind of falls here. And then it increases once you get into a slower seller's market again. And that's what we're seeing right here in this trend line, doing the same exact thing. So when the market heats up in springtime, the less concessions are being offered to buyers. When the market slows down, the more concessions are being offered to buyers. You're going to see this weird kind of trend line here in 2022. The reason this did this interesting move up is because interest rates increased substantially. Really, you could kind of see the correlation. It was right around this time where rates increased quite substantially, and then you saw it just take off in terms of the amount of concessions being offered. And so that's just to tell the graphs in what the market's doing now. Going back up here, we'll kind of do as best we can to stay on our reports. Again, guys, if you're joining me live, tell me where you're from. If not, would love to hear any questions you have so we can cover those next week. Interest rates. Yes, rates spike for the last 60 days. No, mortgage rates have almost nothing to do with that Federal Reserve. Nothing to do with what the Federal Reserve does or who is elected president, other than the emotional response to what things potentially mean. Over the last 60 days, the Federal Reserve dropped the overnight funds rate by 0.75%, and mortgage rates went higher by 0.75%. That's because the lower the Fed rate meant cheaper capital for business growth, which gives investors hope for strong returns in the equities market. And instead of buying bonds, they buy stocks. As money is pulled out of bonds, mortgage rates go higher. So let's talk about that real quick. Let me just what's happening here. So when investor sentiment is optimistic and positive and they feel like the market's going to go up, well, then they're more willing to go in riskier investments. And generally, they're going to put money in stocks rather than bonds. And the reason they do that is because they feel fairly optimistic that the market's going to go up. So they don't really need to put their money into more safe assets, like you could argue a bond would be. And so if you have less money coming into mortgage bonds, well, then rates need to stay higher to incentivize investors to put money into those bonds, right? Well, if you think back to COVID and what was happening, there was a ton of uncertainty in the market. So if you as an investor were investing during COVID, you're likely not going to put your money in risky assets. You're going to limit your risk, put your money in more safe vehicles. And therefore, we had an influx, an incredible amount of money going into mortgage bonds. Therefore, rates dropped. There doesn't need to be as much incentive to get investors to invest into bonds because because back in COVID, it was a safe investment, and that's where people were putting their money. And so they didn't need to incentivize investors to bring money in. Well, that's just not the case in this market. And that's what we're seeing is that rates are staying higher for longer, unfortunately, because they have to incentivize investors to put their money in bonds instead of stocks. While there are many other factors that point to signs of economic weakness, such as labor market, manufacturing, household debt, national debt, and interesting new policies from the incoming administration that will likely drive government jobs markedly lower through cost cutting, creating a short-term spike of unemployment. And believe it or not, these are good signs for interest rates. As investor confidence slides, investment in bonds increases, which decreases mortgage rates. So this is exactly what I was talking about, right? You have a strong economy. You have strong, optimistic investor sentiment. They're going to put money in stocks. They're going to put money in more risk adverse or less risk adverse vehicles to grow their money. But as we see the economy weakened and we get weaker labor markets, manufacturing, household debt, etc., that's going to potentially decrease the confidence in investors, and therefore they're going to choose safer investments such as bonds. And with that, that's where mortgage rates will decrease. But as you can see here, we'll see how long the Trump investor euphoria lasts. And that's a that's a real thing. People are seeing Trump get into office. They feel that nothing but good things are going to come from the economy and stocks, etc. And so, like, if that continues to last and the sentiment is very positive, then we'll likely see rates higher for longer. And what does that mean? What does that mean for the market going into spring? We know, based on the data we've been going over in these reports, that going into December, it's going to be a very, very, very slow market. We have other charts here to just show you how slow the market has gotten and what that means in terms of price reductions, the sold price versus original price. The bigger the gap here, that means that more homes are selling below their original price, which is at an all-time high, all-time high for the year. 70.8, likely to exceed 75%, maybe even 80% by year end. Again, this is the number of homes. This is the percentage of what homes sold under their original price. So as you can see, guys, the market's really, really, really slow. If rates are higher for longer, we're still going to see, in my opinion, a really strong spring season. You have a lot of buyers that are on the sidelines, ready to get into new homes, and they tend to do that seasonally in springtime. So we'll still see a good, solid, strong spring market. But if rates stay higher for longer, I think we're going to see more of a balancing act. Then we will see things get out of control. If we see rates drop to 5 to 4%, the market is going to be really, really strong. You're going to have a ton of buyer activity, but I just don't see that happening. I see rates being fairly stable to where they are, probably bouncing in and around the 6%. Maybe we drop below 5. A lot of this is going to depend on some of the things we talked about early. Investor sentiment, where they're moving their money, how strong is the economy holding up, and with the new regimen coming in, the new administration, like, it's going to take some time for their policies to be enacted, things to actually shift in labor markets, and with policies, the effect of that taking place, it's likely that it's going to take some time before we're going to see some major shifts that come from an administration change. So I think rates will stay a little bit higher for longer. We're going to see more of a balanced market, but it will undoubtedly, even with a little bit of higher rates, we should see a strong spring market. Just might not be as strong as years past. Guys, if you have any questions, as I mentioned, please feel free to comment those. We'll make sure we get to those on the next live. I hope you've enjoyed the content today, and we'll catch you on the next one. Cheers.